Good morning. Good morning in New York. Good afternoon in London. Good afternoon in Africa. We are very, very excited today to have a very interesting and exciting roundtable about sovereign investing in Africa, funds investing in Africa, especially in the context of infrastructure, valuation, and other challenges and opportunities in the continent. And I think after the US elections, this is probably going to be a very, very timely discussion because in light of all the other uncertainties, one thing for sure is that there are many interesting things happening in the African continent. And I think the goal for today is to really get a lot of ideas about what's going on the ground, what kind of projects are relevant to the global market, what are the challenges and opportunities, especially when it comes to valuation, risk management, and other related components of the investment process? I'm Ephraim Chalamish. I'm a senior advisor with Duff Phelps and a fellow at the Global Institute. We are partnering here with Africa investors and CBN under the leadership of Hubert Danso. Thank you very much, Hubert, for being here this morning. Thank you very much for your partnership and friendship. It's always great to see you. And we have a great lineup. I think the context is pretty clear. As we saw over the last couple of years, there is a big interest in alternative investments, especially in the context of infrastructure. Some global funds that we're working with increase allocation to infrastructure almost 10%. In light of the macroeconomic environment, it's pretty clear that investing in infrastructure is becoming more and more interesting. And if I compare the market today to 10 years ago, clearly political risks and currency risk are changing, and we're more knowledgeable about the new tools and the new avenues to deal with these kind of risks. So with that, I would like to give the floor to you, Hubert, so you can introduce some of the themes for today and the wonderful speakers that we have on board.
Thank you very much, Ephraim, for the introduction, and a good day in everybody, and a warm welcome on behalf of Africa Investor and the African Union's Continental Business Network to this African Institutional Investor Roundtable with Duff Phelps, our good friends and partners, where today we're going to focus on the African Union's 5% institutional infrastructure investment agenda and associated private equity related and valuation related opportunities. As Ephraim mentioned, my name's Hubert Danso. I'm the chairman of Africa Investor. I also chair the CFA New York's Global Asset Owners Council, and I'm also the chairman of the African Union Development Agency's Continental Business Network. And as Ephraim mentioned, he and I will co-chair this particular session today. By way of background on the CBN, African Union heads of state established the Continental Business Network, the CBN, in June 2015 as their exclusive infrastructure and African pension and sovereign wealth fund leaders investment advisory platform to deepen the African investment community's participation and in infrastructure across the continent, the African Continental Free Trade Area, and the overall promotion of institutional investor public partnerships, which we'll touch on throughout the course of this roundtable. The CBN's flagship Institutional Infrastructure Investment Partnership Initiative is dubbed the 5% Agenda. The 5% Institutional Infrastructure Agenda, formally endorsed by African Union heads of state, represents a pact between African asset owners, pension and sovereign wealth funds predominantly, and African governments to work collaboratively on project design and better alignment of infrastructure investment policy regimes and programs with the investment mandates of African asset owners. And this includes, as I mentioned earlier, by pursuing the new institutional investor public partnership model, which is similar to those successfully pursued by pension funds and the governments of Australia and Canada as it related to infrastructure investing. In return, African asset owners have agreed to increase allocations to bankable and investable African infrastructure to 5% of assets under management, which will be matched, we trust, by a proposed 1% response from global institutional investors that could be allocated to African infrastructure as an investable asset class. The 5% agenda is designed to complement the African Union Development Agency's ongoing investment initiatives, such as the African Infrastructure Guarantee Mechanism, the co-guarantee platform housed at the African Development Bank, and the Presidential Infrastructure Champions Initiative, which is chaired by President Cyril Ramaphosa, but brings together about 14 of the leading heads of state from across the continent that are really engaged in promoting infrastructure, African infrastructure, to the global infrastructure investment community and colleagues across the continent. Today's theme represents the outcome of the CBN and African Sovereign Wealth and Pension Fund leaders COVID-19 roundtables, which I co-chaired with one of our speakers here today, Uche Orji. And the focus of those roundtables was to formulate a response and better articulate the role of African institutional investors to the COVID-19 pandemic. Lots and lots of great discussions and proposals, but there was really no question about the unanimous agreement that was reached that investing in resilient infrastructure should be our priority COVID-19 response as African asset owners, and that should be facilitated through the 5% agenda. So today we'll be discussing the 5% agenda and its implementation framework, the institutional investor public partnership framework. In that context, we'll also delve into other important 5% agenda-driven trends and partnerships around asset recycling, refinancing, and co-investing with and among African asset owners and globally. We'll also touch on this increasing trend of our governments transferring state infrastructure-related assets to our sovereign funds to manage and crowd in private investors, and the continent's and global capital markets, and recognizing the important role that they have to play through a number of different vehicles, instruments, and innovations. We'll touch on some of them today, such as special purpose acquisition companies, SPACs, infrastructure investment trusts, which we've recently seen endorsed by the G20 and the OECD. And we'll also touch on that important nexus between infrastructure, valuations, and Africa's growth industries. And to take us through this agenda, I've assembled investment leaders for my part of this panel from the continent. So from Africa, we have Uche Orji, who is the CEO of the Nigerian Sovereign Investment Authority. We have Solomon Quaynor, who is the Vice President for Infrastructure and Private Sector at the African Development Bank. And we have Ayman Solomon, who is the Chief Executive Officer of the Sovereign Fund of Egypt. I'm now going to hand over to Ephraim to introduce the international colleagues on the panel. Over to you, Ephraim.
Thank you very much, Hubert, for introducing our colleagues here today and also for describing these important themes for our discussion. Let me just introduce briefly additional speakers on the other side of the Atlantic. We have Genevieve Sangudi. Thank you very much, Genevieve, for joining us. Genevieve, she's a managing director with Carlyle. She's the head of Sub-Saharan Africa, and I think she brings a very unique perspective to the table because she really focused on the growth segment of the market and the connection between new exciting areas like e-health, telehealth, other tech parts of the market with traditional infrastructure. So thank you very much, Genevieve, for joining us today. We have David Scott, my colleague from Duff Phelps, who is a managing director with our alternative investment group. We also have Iraj Singh, who is also one of our leaders on the valuation side, a managing director as part of our valuation advisory group. So I think with that, Hubert, the floor is yours.
Fantastic. Well, in the interest of time, I'm just going to jump straight into this, and I'm going to turn to Uche Orji, just to get us going. And I'd like to just ask you, Uche, and get your insights on a couple of points. Firstly, why, in your opinion, is African asset owner leadership and infrastructure co-investment through the 5% agenda such a high priority for your institution and the continent? And how are you de-risking, transactions from the currency risk and the political risk perspective? And if you could just round that off by just sort of sharing your insights and by explaining how you're approaching institutional investor public partnerships with your own government, policymakers, and regulators. Over to you, Uche.
Thank you very much. That's quite a number of questions packed in there. But let me start by discussing why the 5% agenda is important to us and why it's a priority within our organization. First of all, for those who do not have a background to the organization that I run, is the Nigeria Sovereign Investment Authority. And at the moment, we run 3 funds. The first fund we run is a fund described as the Nigeria Infrastructure Fund, which focuses exclusively on Nigeria infrastructure. The second fund we run is the Stabilization Fund, which helps for stabilizing the economy in times of economic stress. And then the third fund we run is the Future Generations Fund, which is a savings fund for Nigerians. In addition to these 3 core funds of the NSIA, we also manage some programs for the government. We run something called the Presidential Infrastructure Development Fund. And then we also have a co-investment fund, which we've set up for agriculture, which we are running alongside UFF, which is an old mutual-backed specialist agriculture company, investment company based in Holland. So that's just a quick background to what NSIA does. Now, in terms of how we approach infrastructure, as well as how we approach driving this 5% agenda, we invest domestically directly, and then we also co-invest with partners. And some of the projects we are looking at the moment through our infrastructure fund, we have various partners working with us on those projects, starting with the toll road projects under the Presidential Infrastructure Development Fund. Here, we are investing in 3 different toll road projects, totaling more than 500 kilometers, and we're looking to start completion of some of those projects starting from the end of next year and all through 2020 into 2023. We'll be finishing most of the projects. This will be tolled, and there's economic rights across the road all the way through. One is in Lagos, one is in Kano going to Abuja, another one is in Asaba going to Onitsha. Some of you don't know where those places are, but they're traversing some of the most active economically viable areas in our view. It's a public-private partnership. And so our approach to the government is the government has made cash contribution, the asset contribution. The NSI is investing, and we're opening up soon to participation from pension funds and other participants in the spectrum who might be interested in this. Outside of the toll roads, we also now invested in power. We are on track with our first solar power plant, which we're building up in Kano, 10 megawatts. It's small, but we're planning a program around it to roll out a series of these across various states in the country to enable specific industrial parks to operate. Agriculture, healthcare, we're very active in healthcare, and also we're very active in gas industrialization. Here you're going to see we made some announcement. We're working with OCP to stop flaring gas and using the flare gas to produce ammonia at first instance, but there are also other projects in the pipeline, such as gas to LPG, that we are involved in. So driving a significant chunk of domestic infrastructure for us is the main purpose of this fund that we're running. And of course, in addition to running other specific programs for the government, those who are following the story at the NSIA know how active we've been in this front. In addition to this, we are creating co-investment funds. The first one that's been successful is the Agriculture Co-Investment Fund. A couple of others that have been worked on will be announced very soon, spanning everything from industrialization to innovation. So we're very, very active in driving significant investment in the country. Of the 3 funds we run, the first 2, the Stabilization and the Future Generations Fund, are 20% and 40% respectively, whereas the Nigeria Infrastructure Fund is currently 40%, rising to 50%. So all I'm saying is that there is an active interest in driving significant domestic investment in infrastructure, and this is an area of focus for us.
Fantastic, thank you.
The question is about how do we de-risk it? We de-risk it by being present in it ourselves. Secondly, and more importantly, just in so doing, we're able to traverse both the regulators, the government side, and also giving comfort to co-investors that come with us. We've created an infrastructure credit guarantee company, and we're looking to raise the capital base of that entity significantly. But watch this space for other programs that will help in de-risking the assets. For example, on the road projects, the funding that's coming is going to come with sovereign guarantees. So to the extent that we have investors coming in, we're able to get that working. So these are some of the things we've done, and I'll probably just stop here and then take questions later on. Thank you, Vivek.
Fantastic. Thank you very much, Uche. And you're certainly giving us a lot to watch when you say watch this space. You're clearly doing some really great and innovative things. And I think one of the most important things that you're doing is you're helping to really create this understanding about African infrastructure as an investable asset class and giving perspectives on how you're successfully doing it and how others can join you in that effort. So I'm now going to turn to someone else who's got a long, well-storied track record in this particular area, to Solomon Queno, who is one of the continent's leading and largest infrastructure financiers from the African Development Bank. He's a true infrastructure investment veteran with all the medals as well as the scars to prove it. So Solomon, I'd like to just ask you to share with us your views on African infrastructure as an investable asset class, especially through mechanisms like asset recycling and refinancing. And again, I'd also like you to talk to some of the de-risking models available in the market that can protect and give comfort to institutional investors about how they can manage African currency and political related risks. Over to you, Solomon.
Okay, no, thank you very much, Hubert. Before I start, though, when Genevieve was introduced as an international, I was a bit confused because I thought she's part of us. And part of the reason I say that is, we were investors in the first Carlyle Africa Fund. We've had a very good experience, as LPs. I know that they're in the fundraising mode, and we're very supportive, really, of the fundraising because we're going to really need that capacity, on the continent as we look at the post-COVID recovery. But let me come back to your question, Hubert. The infrastructure asset class in Africa, and really what are the opportunities and challenges. I'd like to be open. I mean, the biggest challenge that we have is the addressable gap. Okay, is definitely wide, but the biggest challenge has been converting addressable opportunities to really bankable opportunities. So just to give you a sense of really what that gap is, so that you get a sense of, of the demand. The African Development Bank estimates that, the gap pre-COVID was between $70 billion to $110 billion a year. Post-COVID, clearly that's widened, and it's also widened even from a sector perspective. But that gives you a sense really of the demand. Now let's take a look really around risk. There's perceived risk, there's actual risk. If you take a look at the default rates, Moody's Analytics in 2020 did a 10-year look back at the cumulative default rates. Africa was just 1.9%. I mean, this is as compared to Eastern Europe, which is closer to 12%, and it was even better, interestingly enough, than Western Europe. The only region that had a lower cumulative default rate is actually the Middle East. Okay, so this goes to show you that there's a huge difference between perceived risk and actual risk. When we take a look at default rates. Now, let me also try to walk through. Now that I've talked about demand, I've talked about default rates. Let me talk through a little bit about what the return picture looks like along various parts of the value chain and infrastructure. So if you're bold enough, and once again, as you recall, I said the biggest challenge has been really developing projects to bankability. So if you want to come in at the development equity point, most likely these projects could take between 12 months, to 3 years to develop. You probably would make, at the end of project development, 2 to 3 times money. Okay, but once again, maybe institutional investors are probably not going to be most comfortable with, project development risk, because you have to take a portfolio approach. You'll win some, you'll lose some. Some may not really give you the blowout returns, and so there are different, entities that really play at that level. And a good example is Africa 50, which the African Development Bank established to really focus on project development. Now, if you come in after the project has been developed and you have a bankable project and you invest equity at that point, and let me use power as a good example. which is a regulated, entity and doesn't really have the opportunity of a lot of ancillary revenues like you would toll roads, which I was talking about toll roads. The equity returns have been really between 16 to 20%, over the last, several years. So, but this would be equity that takes really construction risk, that takes, risk around implementation of the PPAs and all the credit enhancements, etc. But let's assume you wait and come in probably post-construction, stable revenues, payment mechanisms tested. We're talking about, if you come in, on a secondary basis, we're probably talking about returns that are more around, plus or minus, 10%, which are still very attractive returns because I'm talking about US dollar returns. I'm not talking about, local currency returns. And you have to remember in a lot of these, infrastructure, asset classes, there's a natural indexation to currency changes within the tariff formula. So you have that natural hedge, in there. So opportunities there. And, when we take a look now at, the post-COVID era, a lot of governments are talking really about focusing on infrastructure-led recovery. So what does this mean? We have countries that probably are in a little more of debt distress. I'm not saying that they're debt distressed. They have limited fiscal space. And so they're being very selective on which infrastructure projects, they implement. But more importantly, they're providing really the right mitigants to make investors comfortable. So this is where, the political risk naturally is getting diminished, but let me touch on political risk for a brief second. So you can get PRI from MEGA and other institutions that would cover expropriation risk, convertibility and transfer restriction risk, breach of contracts, etc. But naturally, those are really primarily post-arbitral awards. So I just want to focus really on, what it is that we do in the meantime, because, these PPAs tend to be, 15, 20 years if it's a transport project, even longer. How do we manage political risk really on an ongoing basis? So this is where we as the African Development Bank, are able to provide great comfort, because some investors, even if they have government guarantees, are looking for some counter guarantees from institutions like ourselves that they believe will be fair and balanced and would ensure contract enforcement. So this is where we can come and counter guarantee government obligations, and we do this really on an ongoing basis, whether we're looking at partial risk guarantees, to backstop government payments, whether we're looking at, counter guarantees of viability gap funding on toll roads. These are really areas in which, we as the African Development Bank and other MDBs, can support. But more importantly, beyond the instrument, we've had long-term relationships with all of these governments. The Minister of Finance in every country is part of our governance structure. So the ability to really access government whenever there are issues and look for resolution that would be fair and balanced happens naturally with our involvement. So my encouragement is that, global investors, African investors should take comfort in projects that, MDBs like ourselves are really associated with. Now, there's another level of comfort that is emerging, which would be with what I call the sovereign wealth funds and also the strategic investment funds. Like NSIA, like FONSIS in Senegal, like JIF in Ghana with Solomon Asamoah, like IFMA in Morocco, etc. Having these partners on the ground, that maybe quote unquote quasi-government, and have good relationships and can help manage, situations in real time is fantastic. And we're looking to support these parties as well. But Hubert, let me stop here. You gave me a handful to try to answer, but let me stop here.
Fantastic, and you dealt with it so well, Solomon, and thank you for that. You touched on some really critical points that have really constituted the framework of the 5% agenda. This whole issue of what I describe as the infodemic, the misinformation in the market about the actual versus the perceived risk, and then some of the opportunities that are missed by investors by not necessarily having accurate data to be able to price or consider their participation, and of course it's to the detriment of a lot of projects that we're paying a premium where actual risk, where perceived risk is priced in. So that's an issue. And you also touched on the fact that the infrastructure project development model, as opposed to project preparation, can give you 1, 2, and in some cases 3 times money. That's just unheard of. And I think the way that we've gone about this in the 5% agenda is to really structure those early stage pre-financial close type opportunities as financial risks. Previously, they were really sold much more as development risks to development finance institutions. But under the 5% agenda, as you've mentioned, there is a way to structure them as a financial risk that we as financial asset owners and investors can take. So I'm going to just quickly now move to Eamon, just to close us out with our African perspective. And Eamon, you recall, as I mentioned in my sort of opening, that about this sort of increasing trend of the 5% agenda for governments, our governments, to transfer state-owned assets to our sovereign funds, like yourselves, to manage and crowd in private investors. Briefly tell us about your experience in this respect and how this can be leveraged to crowd in domestic and African global institutional co-investors. Over to you, Eamon.
Thank you. And I actually take my cue from Solomon's very encouraging stats on the market and the risk-adjusted return in the infrastructure capacity as a solution to de-risking the entire economy. There's a big element of capital recycling there. In our experience in Egypt, for instance, we are looking at major infrastructure assets that have already passed the development risk. So there's an element of brownfield transactions that are there, de-risked asset classes, and with those de-risked investments, be it in power plants or in the desal stations, plants, those are very attractive propositions. They also enhance the macro picture. So if you're coming in and pricing them at a decent risk-adjusted return, like around the 10%, for instance, by doing so, you're deconsolidating significant amounts of government debt. There's capital recycling, so you're returning a lot of that capital back to the Ministry of Finance. So that capital recycling, inherently deconsolidating debt as well associated with those assets, then you are de-risking the entire economy, and your actual return becomes a lot more secure. And of course, building in or banking on all those de-risking elements, be it the bilateral investment protection agreements, be it the mega insurance, be it all those, and the sovereign guarantees attached to those particular assets, that's a big plus that becomes a self-fulfilling prophecy, and those assets will become valuable by the day. And following that example, we are helping our government and helping the relevant asset owners to recycle their assets through the fund, where we say we're advocating a product where we say this is a power plant, this is a mega investment that has been de-risked, the development is behind us, it's recently commissioned, and now we're taking that to the market in a brownfield setup. And we as a sovereign fund, we are tagging along, co-investing alongside the developers or those bidders, and we don't influence the pricing mechanism because this is run independently from us, but we are underwriting a tag-along investment with a minority ticket, say around 30%. This is skin in the game for a government-owned private equity institution like the sovereign fund. We have good alignment with them. We help structure and create the ownership mechanism that satisfies the needs and makes it a mainstream investable product for our co-investment partners. This is our value add to the proposition, and we have enough skin in the game, and we create that alignment. That is a model that we're trying to portray. In other cases, you're also recycling capital through creating, repurposing to other assets, be it concessions around hospitals, be it concessions around other classes of infrastructure, be it highways or management of highways. Those are all, if you turn them into concessions and you express your appetite to co-invest and you tag along with a minority position or a minority stake, that is a good alignment. And this is how we structure our co-investment. And of course, as we've been discussing with Hubert in many other avenues and discussions, it is that positioning, the institutional partner that is co-investing. We're not promoting investment opportunities. We are actually co-investing alongside our partners in those and deploying our own balance sheet against those investments as well.
Excellent. Solomon, that's a great segue. Thank you so much for those comments. I'm just now going to switch over to Ephraim, who's going to bring the international panelists to give us their views on the nexus between infrastructure and Africa's growth industries, as well as some global best investment valuation practice insights. Over to you, Ephraim.
Thank you, Hubert, and thank you, Mr. Salomon, Mr. Ayman, and Mr. Uche for terrific comments. I think we all learned by now that one of the biggest challenges is really the understanding better the gap between the real risk and the perception of risk, as Salomon said. And we at Duff Phelps really spend a lot of time on trying to understand and quantify, which I think is a key issue here, quantify the risk better. So asset managers, asset owners, co-investors, and all the other players that you refer to understand the risk better and make better choices. Also, as our colleagues here mentioned, this infrastructure gap that you, Solomon, talked about well, we see that in advanced economies as well, in the States, in Europe, in some other parts of the world. So I think understanding that this is a key issue for recovery post-COVID, it's actually a universal concept and not only an African concept. And I think the African content under your leadership and the other governments and sovereign funds here can really take a lead. And hopefully this roundtable is just a beginning. And I encourage all our participants here around this roundtable, virtually, of course, to reach out to us after the roundtable to think about concrete ideas how to connect with the African Development Bank, to the sovereign funds, to the private funds like Carlyle, to think about specific ideas how to get involved in some of these projects moving forward. And here I would like to bring Genevieve to the table. And I think you and Carlyle, we've been working with Carlyle for a long time. You have a very interesting angle here because you cover both the growth sectors of Africa, but at the same time, you always think how to connect it to other part of the fund, to the infrastructure fund. So please, the floor is yours. Please share with us your experience and your work on the field.
Sure, thank you so much. And let me first start, Solomon, by giving you comfort that I am definitely still on your side of the pond. So, definitely still a dedicated Africa investor. And I think the experience that Duff asked me to share was just coming from the perspective of, a large global institution like Carlyle. So first, just a little bit, I've been investing in Africa for the last 16 years through corporate private equity firms. So first with Emerging Capital Partners, and then with the Carlyle Group, and then with Altera Capital Partners. So even though I'm not a traditional infrastructure investor, I'm participating in this conversation because I think there is significant overlap between private equity and infrastructure on the continent. And I think we have an opportunity to reimagine what infrastructure means in a post-COVID world. So look, while private equity firms are not particularly well suited for your typical infrastructure investments, like what you, Solomon and Uche and Ayman have described, and that's primarily duration and target return. So standard private equity firms have 10-year life, so 5 years to commit the funds and then 5 years to harvest the funds. And as you know, infrastructure projects can take significantly longer than that. And we typically also look for returns north of 20% IRRs in US dollars. And so just from a duration perspective, while the money multiple might be there, it's hard to get those IRRs over a longer period of time. However, through investing via private equity, I think one can still get exposure to infrastructure light assets across the continent. And private equity, I think, can play a significant role in building the requisite companies that are necessary for Africa's development. So one of the things I wanted to talk about and to answer is how can we target investments that can help African economies, countries sort of leapfrog? And I think we have another opportunity because of COVID to just reimagine how we live, how we work, how we transact, etc. So historically, a few infrastructure-light sectors that have been particularly successful for private equity in Africa and for my funds include telecommunications, financial infrastructure, healthcare, agriculture, logistics and transportation, to name a few. These are all obviously critical sectors for sustained growth and development. And just to give a few tangible examples, let's take telecoms. So most of us know the very successful GSM story and probably the best example of leapfrogging on the continent, right? Able to bypass fixed operators, and voila, 20 years later, 75% mobile penetration. And really that has become such a critical component in terms of how people live, learn, work, transact, etc. However, post-COVID, I think significant opportunities remain for investing in companies that will now continue to build upon, telecommunications and technology infrastructure. So how we're thinking about it would include data centers, cloud computing, fiber networks, all things that I think will still fit within the PE time horizon, but still deliver, the infrastructure that are critical for development, as well as deliver the requisite returns. Another example I wanted to give was around financial infrastructure. So given the relatively low penetration rates of core financial services, obviously improving and getting better, I believe this is yet another sector that we can leapfrog in Africa. So leapfrog all of the traditional bricks and mortars, branches, etc. So sectors that we are looking in and playing in include e-payments. A number of our, peers across the continent have been very successful in this. In the last 2 years alone, we saw Visa buy a 20% stake in InterSwitch, a payments company in Nigeria, underpinning $1 billion valuation. So one of the first unicorns on the continent. And then most recently, we saw Stripe, global payments business, acquire another Nigerian payments company called Paystack for $200 million. And something about their tagline really fascinated me. Their tagline said, Paystack helps businesses in Africa get paid by anyone, anywhere in the world. And they're able to do that without, quite frankly, much sort of physical infrastructure, so they have their technology, they have their backbone, etc. So think about what this means from an infrastructure perspective and what it means for making small businesses work better. So it's not just roads and bridges, but companies like this, I think, are just as critical for economic growth. And I think we're gonna continue to see more challengers in the financial infrastructure and telecommunications space. I think lots of other examples in a number of other sectors, which I won't go into now, but one other thing I wanted to touch upon, in addition to the opportunities, obviously there are risks, and we get asked quite a bit about, main risk factors and then how you mitigate against those. So for us, given the types of businesses we do, the types of companies we invest in, look, there's always the macro risk, right? Medium and long term, we strongly believe African fundamentals remain the same. And so, I think that continues to hold. However, there have been and will continue to be short-term volatility, uneven growth, inflation spikes, et cetera, across the continent. And one way you mitigate that, I think, is with diversification and also focusing on the micro and not just the macro, right? So focusing, which are the businesses that are going to be appropriate challengers in a particular sector and that could have the opportunity to become market leaders, I think is how you get around some of the macro issues. Currency, we've seen significant devaluation, especially across our major currencies. The Rand, the Naira, it's just too painful for me to think about over, my 16 years investing on the continent, what has happened to those currencies. So once again, it's too expensive to hedge and just not practical. So how you mitigate a risk like that, I think diversification, once again, investing in a basket of currencies, as well as, again, targeting businesses with pricing power or revenues denominated or linked to hard currency. Look, there are other partner risk, I would say, is still the most important risk for private equity investors, and something that I think global firms will continue to struggle with, right? If you don't have local teams on the ground, boots on the ground, then it's really tough to make the right kinds of judgments around partners. So I think, partnering with the right fund, always invest with funds that have people on the ground, people that are part of the fabric of the societies in which they live. And I think that also is a mitigant, when things go wrong, in terms of just being able to solve that. And look, finally, liquidity risks, right? I think it's very hard to attract the quantum of global capital needed to meet Africa's infrastructure and other needs without mobilizing domestic capital. So this conversation, very timely, and I think extremely encouraging.
Thank you very much, Genevieve. That was terrific. Lots and lots of things to think about. One thing for sure, I promise you that's going to be my last time. The last time I'm going to call you an international investor in Africa. You're truly one of the best ambassadors, both for Carlyle and the international investment community, and we're proud to have you here today. And based on your comments, and obviously many of the things you mentioned, these are things that my colleagues Dave Scott and Iraj are dealing with on daily basis. So now with that, Dave and Iraj, please share with us your experience with some of the risks and valuation challenges and opportunities that you've been dealing with over the years. And I think many of the funds mentioned here are funds that you get a chance to get to know closely. So Dave, the floor is yours.
Yeah, thank you, Effie, and thank you for having me. It's a pleasure. My comments here will be from kind of a global infrastructure perspective. Maybe my remarks mainly geared more towards those experiences we've had in some of the more mature infrastructure markets. But I want to echo, what Genevieve really alluded to as far as opportunities coming out of COVID in Africa. Digital infrastructure, healthcare, those are growing importance. I think obviously those travel and transportation, hospitality, and certain energy sectors are in the eye of this storm right now, and those valuations may see some impairments. But focusing on those digital and infrastructure and healthcare sectors, I think is critical coming out of COVID. Before we get to talk about risk, one thing I thought was interesting that we've seen, kind of globally coming through this pandemic from infrastructure investors is really, I don't want to say a phenomenon. It's really more of a learned reaction coming out of the previous financial crisis, 10 or 12 years ago. Is we've seen investors continue to invest through this cycle, which I think they've learned a few things. That 10 or 12 years ago, they were afraid of that denominator effect, so to speak, on their portfolios, and we've seen them kind of coming out of that downturn in the economy, really missing many investment opportunities. They've learned from that experience, it seems like, generally, and once they really assessed the valuation concerns around their portfolios and liquidity concerns, they really shifted quickly to attractive investment opportunities. So I think that's critical. Many of the panelists here have talked about the various risks that we've seen, whether or not it's construction and operation or credit, servicing the debt, the revenue side of the equation, and demand risks and renegotiation of contracts, and political risk we've talked about very eloquently on this call. We see all of that. I think, Iraj, if you have some comments specifically that you've seen in the continent, would love to hear those.
Yeah, thanks everyone. This has been a very fascinating, I think, trawl around Africa as well. And my perspective on this is, look, I've been valuing in this energy and infrastructure space for the last 20 years. My early experiences with infrastructure were in London, which today you'd say in the UK is a pretty mature market when it comes to infrastructure. investment framework opportunities, but also mature in terms of returns. And over the last 20 years of playing in this space, I've observed a couple of material things. One is the definition of infrastructure has progressed over the last 20 years. When I started out 20 years ago with the primaries, PPP, social infrastructure primaries, they were seen as an asset class that was in between government debt and a very safe equity. And so they were being priced as a couple of a few basis points, a couple of hundred basis points above gilts, sovereign debt. And that was for social infrastructure. That was for the PPP, PFI, public-private partnership, public finance initiative, that type of social infrastructure risk. And over the years, we progressed from the PPP model. We went into the definition of what core infrastructure is, progressing to taking on more economic risk, regulated asset risk. So, trusting an economic regulator to give you a fair return, moving on to economic risk, moving on to, we started going into something called Core Plus, which is, you take on more economic GDP risk, and today, that spectrum has moved on to, today I'm looking at those same infrastructure funds that I started working with 20 years ago. Today looking at, now infrastructure has moved to data centers, right? It's moved on from, real estate being that sort of safe asset class to right now, the infrastructure funds, the pension funds in Canada, Australia that I work with, the global infrastructure funds, they're looking at data centers, cloud technology, that is now becoming, moving into what infrastructure calls Core Plus now, as opposed to Core Plus Plus. So definitely, definition of infrastructure over this time has changed and has progressed. But at the same time, what you have is the risk profile has also changed. And so, in developed markets, you're seeing this risk profile starting to be priced in more and more. And so, as information comes through, what we're seeing in the developed infrastructure markets is that the returns are starting to come down, and people are starting to accept some of the risks in this, the higher risk, higher return investment opportunities. Sorry, I'm going to pause there. Can everyone hear me?
Yep.
Okay. Yeah, we've got you.
Okay, good.
Eraj, because we unfortunately we have only about 10 minutes left, and we would like to take a couple of comments and questions, if you don't mind, with your permission, maybe kind of last points on your side.
Yeah, okay, so actually the point I was coming to and bringing that into Africa, and sorry, my long-winded ramble maybe, the point to Africa is, and my experience with Africa, and I have worked in infrastructure in Africa, valuing toll roads in Nigeria, in South Africa, and working in Angola a lot, is the risk feedback mechanism. We talk about perceived risk, we talk about actual risk. As global investors, if it's not OECD, investors get very, nervous about risks, and they take perceived risks, so they look at default risks and things like this. But that is a perceived risk. The actual risk is the experience of having invested in the asset and having those returns communicated. As a valuer, what we lack coming out of Africa is that feedback cycle. The experience of investors. We don't have much reporting that can really help us to move the dial from, okay, where's the perceived risk and what's the actual risk? We don't have enough information to calibrate that perceived to the actual. But we know the actual is, because actually, when we see investors, they go in with a 15%, hurdle rate, but actually their actual returns are pretty healthy. So they have paid a discount to go in, but they're getting pretty good returns. Actually, when they look back, in the rear view mirror and look at what are the realized returns from that investment, they're pretty high, right? They're pretty good. And that's the bit that for me as a valuer, it's the feedback mechanism and the information recycling.
I think
if I might take just 30 seconds
yeah,
to
please do.
add on to that. That's why I think really valuation and understanding the fair value best practices is critical, because when you have that transparency, and investors are able to make apples to apples asset allocation decisions, they're actually able to see those returns and have that transparency. I think that's critical in that cycle that Iraj is talking about.
That's terrific. And in fact, thank you very much, Iraj and Dave. Actually, in many respects, Genevieve's point about kind of the sectors of the future, it's really tied very nicely with our efforts here today to bridge the gap between perception and reality. Because if you think about it, many interesting tech companies now are dealing with big data management, including in the infrastructure space. So even within the Duff Phelps family, and now we're trying to connect between tech tools and traditional human tools to get the feedback mechanism that Iraj referred to before. We have a few minutes left, and we have a couple of comments and questions both from the floor and from around the table. So Hubert, please share with us a couple of quick comments and questions that we have around the table. Thank you.
Fantastic. No, thanks everyone. You've really touched on a subject that's very close to our heart at the CBN. This whole, as I mentioned, this infodemic, the actual versus the perceived risk. But we do believe that there's an opportunity, and we're working very closely with the African Development Bank and other like MDBs on this agenda. We think that there's an opportunity to democratize data. You have a lot of the data that Iraj and we're all talking about currently exists in a GEMS database, where a lot of the MDBs have actually been putting that data in there for a very long time. We feel that if that data could be made more available, we think it would make a real dent on the this whole issue of not being able to determine and evaluate the difference between perceived and actual risk. And the African Development Bank, with one of its landmark transactions last year, a room to run $1 billion plus securitization program, the real difference was in pricing that particular transaction was the ability to get access to the GEMS database so institutional investors could take a better view on the risk. And we feel that through the ADB's continued leadership and innovations of these types of capital market instruments, there's a lot of opportunity, because we basically, being in the infrastructure investment space, our new concept is we also see data itself as infrastructure. This data is really going to be the infrastructure of the future, and that's certainly an opportunity. But also, I think in the early part, as Ephraim mentioned, we have someone on the floor that I think can really help us just get a 30-second to 1-minute perspective on how to intermediate the capital markets as it relates to infrastructure. So I note that we have Fraser Hughes, who is the CEO of the Global Listed Infrastructure Organization. So I'd like, if you're okay with that, Fraser, if you could just put your camera on and just give us that 30-second to 1-minute view on this emerging trend of infrastructure investment trust that's being driven by the G20, and we hope will be tested for some of the first time on the continent. Over to you, Fraser.
Yeah, thanks, Hubert. Just by way of background, I think the concept of an infrastructure investment trust is really based on the real estate investment trust, or REIT legislation, which is now in force in around about 40 countries around the world. REITs were started, as many of you know, in the US in the 1960s. In Africa, you've got REITs now in Kenya, Nigeria, and South Africa. In my old role, we were quite influential working with the South African REIT Association to get REITs up and running in South Africa. What you've also seen, and Tom mentioned this before, is in recent years, REIT structures have kind of expanded on what they permit to now include infrastructure assets. So I guess the largest example of that is the telecom infrastructure companies in the US, of the towers. So of my GLIO members, American Tower, Crown Castle, and SBA They're some of the largest global REITs these days, and they represent about 150 billion in asset value. So we really believe that the REIT structure can act as a blueprint for a clearly defined infrastructure investment trust. And what we've done over recent years is work with the G20 OECD, and in their latest report on institutional investment in infrastructure, they included our recommendation for an infrastructure investment trust, or an IT. And that's really a way to try and bridge some of this $15 trillion infrastructure investment gap. So very quickly, why could ITs be beneficial for the African continent?
Hopefully in 30 seconds there, please, Fraser. The 30 seconds closing. Yes.
Look, it can attract in domestic and international capital. It's got the transparency of stock exchange and disclosure, etc. You get liquidity. The vast majority of earnings pass through to the shareholders, and they're taxed at the shareholder level. You get diversification, and of course, it can work anywhere. There you go, Hubert.
Starting on the continent. Well put there, Fraser. But I think all of these things are premised and based on partnerships. And we've talked about co-investment partnerships at two levels. We've talked about co-investment partnerships between African sovereign investors investing across the continent with our peers in each country. That's under the 5% agenda. We've alluded to the 1% agenda, where we now want to work with global institutional investors to co-invest with African sovereign investors. That's the second dynamic. The third dynamic is actually beginning to organize consortiums of our own institutional investors in country to be able to invest in the asset class. And I couldn't help but noticing we have Ngasia Kirungi on, who's the CEO of the Kenyan pension fund consortium. So again, in your 30 seconds to 1 minute, Ngasia, please just give us a perspective about how you approach that as a consortium of African institutional investors at the domestic country level. Thank you.
Thanks, Hubert. And this has been a great discussion. So just a quick recap. So KEPFIC stands for the Kenya Pension Fund Investment Consortium, and is a consortium of local pension funds that have come together to jointly co-invest in infrastructure opportunities. Now, the size of the Kenyan pension fund industry is approximately $130 billion. And our regulations allow us to put in up to 10% of our assets into infrastructure. However, majority of our schemes, or majority of our pension funds are small. We have 1,300 pension funds in total, and many of them are far too small to effectively invest on their own into infrastructure, both in terms of the deal size and the costs associated with the investment process. So you think about the costs of the due diligence, the deal analysis, the technical, legal, operational advisors that are required are pretty high. But by pooling together our capital, it allows the smaller schemes especially the opportunity to invest in infrastructure, and allows us collectively to look at larger opportunities as well. Now, this has been a real game changer for global institutional investors that are looking at our role in de-risking opportunities. These international investors want to see that the local investors, who should have a greater or better understanding of the local risks, are actually participating in these opportunities, and it gives them a lot of comfort to see that KEPFIC is doing that. And you have to remember, we share similar needs. We have, the need for long-term assets to match our long-term liabilities, and the search for competitive returns that are often inflation-linked as well.
Thank you.
Fantastic.
Thank you very much. Before since we're almost, unfortunately, we're very close to the end of the hour, but it's been a terrific roundtable on all fronts. And before I'll let Hubert to say the final words, I can tell you that the people around the table, the virtual table worldwide, I'm sure they learned as much as I did, whether these are new capital market oriented tools, as Fraser just shared with us, or pulling capital together in order to make the funds more reliable and interested more in investing directly in project, or all the various sovereign funds and international institutions like the African development banks, including also the private entity like Carlyle and others. I think it's critical that we all come together in order to take the African infrastructure story to the next level. And I also want to take this opportunity and thank my colleagues, Dave and Iraj, for sharing with us best practices when it comes to valuation and investment management. And of course, this webcast will be available and you will be able to watch it again over the next couple of days. Hubert, the last word is yours.
Thank you very much. I'm not sure it's required because you just did an excellent summing up, Effie, and thank you for the partnership. And we really do appreciate that, and we want to work with you and your global clients to get access to some of these phenomenal opportunities that our good friends and colleagues have just been sharing. But I would just like to ask everyone to in the audience to just join me in virtually thanking our excellent panelists for sharing their seminal insights. And thank you, for as sort of the audience for taking the time to participate in this important discussion. As we say, this is more the beginning of an important journey that's led by asset owners and the institutional investment community, doing the things the way that we understand how to make a success of them, and at the same time contributing towards what I describe as the Invest Back Better agenda to tackle the COVID and act as a COVID response. So please, finally, just do reach out to Effie or myself if you want to learn more about African co-investment and in infrastructure investment opportunities, or valuation trends and best practices, or be connected to anyone on this call. And we really do hope that you reach out and get connected, because the people that you've heard speak today are the ones transforming the face of infrastructure investment on the continent. Thank you, everybody. Be safe. And with those words, I formally close this roundtable. Thank you.
Thank you all. Thank you very much.
Thank you, everybody. Cheers.
Thank you. Cheers. See you all soon in person.
Thank you, everybody.
See you all.
Cheers.
Thank you.
Thanks.